What's up, guys? Welcome to today's episode of the Bell Zone, where I talk about all things real estate, money, finance, cash flow. Let's go. All right. So I think this one is a great video because I was talking to Prashana. She's on our real estate team, and we were talking about investing versus speculating. A lot of people have this question. So I think this is important. So investing versus speculating. Investing versus speculating. Like, why are people so confused with this thought? And I can tell you why, is because we've all been taught to speculate. It is easier to gamble. If you roll dice, if you go to the casino right now, you're going to gamble. That's speculating. You're going to be guessing what's going to happen. Why? Because we've all been taught buy low, sell high. That means that whatever you've bought, speculate, you're hoping that it goes up or your thing doesn't work. But when you're investing money, that is not the thought process behind what you're doing and why you're doing it. And I'm going to go over that today, all right, with you guys. I think it's important. So like when you think about this, and I want to drill this home so you guys get this, whether you get this with me or you get it on your own or you get it with somebody else, get this. So that way no one's confused about what we're doing and why we're doing stuff. All right. So when you think about speculating, you think about people in stocks, bonds, IRAs, crypto, crypto, all of these things, any Wall Street stuff. This is all speculating, guys. This is speculating. Why is this speculating? Because this falls within that line that you're going to buy something, and then as it goes up in value, you're going to sell it. You don't know what's going to happen, right? Wall Street, like the stock market itself, has actually crashed 12 times since 1950. Look it up on Google because I did. The stock market itself, Wall Street, the stock market has crashed 12 times. So when you think about investing, it's not an if the stock market or Wall Street's going to crash or prices are going to go down. It's when they go down. They typically go down about every 7 years. So if you think about just that thought alone, if you invested in the stock market, let's say you were, some of you guys may be around where you weren't, but let's pretend. Let's say you invested, you had money in a 401k IRA in 2007. 2007, and let's say you were 70 years old. Dude, you lost everything. You lost everything. Why? Because your IRA, your 401k, your pension plan, your stocks that were in the stock market, all the shares that you own, they went to zero. People lost everything then. Why? Because they were speculating. But let's say you had an apartment building. You were invested, you had money in there, right? You had 100 units, and let's say you were getting paid 10K a month. Right? Let's use that example, right? If you had invested money in an apartment building, you're making 10K a month, and let's say your apartment building during that time went down by 20%. Let's say it went down to 20. Let's even go further. Let's say it went down 40% in value. You don't care as an investor. As an investor here, you were speculating here. You were speculating. You were hoping it was always going to go up. But as an investor here, let's say your value of your property went down. You don't care. You're still getting $10,000 a month. That's the difference. But this is what investors do. Investors put their money into real income producing assets where the values can't be easily destroyed. That's not gambling. That's not speculating. That is investing. This was the speculation market. So just that alone, when you kind of go through those things, you start to see the difference. Especially like when I said before, as an investor, you're just looking at like, hey, if I put my money here, first, am I going to lose money? You hear me talk about all the time. What is my investment priorities when I'm looking about investing money, investing my investors' money? Will we lose money in this deal? First. Next, we're looking for cash flow. So what did I say? We're like capital preservation, preserve capital. That's the number one thing we're looking for. Don't lose money when we're investing money, right? Because we're not speculators. We're investors. Next, cash flow. Right here. Cash flow. Does this property kick off money every month? Does it pay for itself? All right. And then next, we're looking for appreciation. Could it appreciate? Could it go up in value? Does it have natural appreciation? Just if we did nothing, will this thing continue to go up in value because it's a desirable property? People are renting there. They're paying money on it every month. They're paying for where they live at, and it's going up by just baseline inflation of the market. Rents go up roughly 3% every year. That's kind of how things have been going over since really also the 1950s, because that's when this whole thing kind of started spiking and taking off. Rents have constantly gone up since that time. So, and then last but not, well, there's more than last but not least, but can we get tax benefits? We didn't even talk about that earlier. So look at it from this perspective. We talked about the speculation part. Yeah, which page can I write on with you guys? I'll write on this page. If you have an IRA, 401k, right? If you have this, let's say, for example, you saved up a bunch of money and you were going to retire, and you were going to take out 100,000 for that year, and that's what you made. You're still in the same tax bracket as you were when you worked. So financially, you didn't do well, right? You don't have anything to offset that income. You don't have any tax benefits to do that. So you're still going to be paying taxes on the same $100,000 as if you were still working. So you're not any better off. So your IRA 401k is not going to be the best thing for a lot of people looking to come out of this as you talk about being an actual investor and growth. All right. So, but I bring that up to say, getting back to my main point here, the tax benefits of when we're looking at an opportunity, we're like, hey, do we get the depreciation of the asset? Could we do cost segregation so we can do what's called accelerated depreciation, where we can pass that on, those tax benefits, to our investors? And then when we do that, we're getting to offset additional incomes that these people may make. So you may not make it, you may not have to pay tax on the money you receive so far as the returns. Plus, you may be able to use some of that to offset some of your other income, depending on the tax brackets that you're in. So that's the thing that I look for too. What are the tax benefits of this opportunity? And leverage. Can we make $1 buy $3? Could we leverage our dollars? $1 buys $3 in real estate, sometimes $4. But we're looking to say, hey, if we put down a certain amount of money, the money we put down, could we borrow the rest of it from the bank? That's good leverage. We're not talking about the bad debt, bad leverage that your mommy and daddy, your aunties and uncles say, get out of debt, pay your stuff off. That's credit card consumer debt. We're talking about using debt to buy an asset and putting down a portion of our money because the bank wants to do it. All right. So this is important. And for you people out there that are like, what about diversification? Let's use that. And we're looking at scale. So when I'm looking at a deal, I'm like, sheesh, do we do one house or do we do 100? Right? One house or 100 units. What would you rather? Would you rather have, if you're looking at this as an investment opportunity, would you rather have one client, if you're going to buy a business, because buying apartment complexes and communities and business and buildings are buying businesses, they're functional businesses. So if you looked at buying a business, let's say you were buying a t-shirt company, would you like one customer coming in a month? Or would you like to have 100 customers coming in a month that are all qualified to buy? They've been buying, they're going to keep buying your t-shirts, and they're on contract to continue to buy those things for 12 months, 24 months, 36 months. Like, that's the difference. So scaling or diversification, like some investors like to talk about, the more units you have, the more diversified you are. Let's say this 100 units, let's say you lose one. If you have one house and you lose one tenant, you're 100% vacant. If you lose one tenant over here and 100 people, you won't even notice they're gone, right? You can lose 10 people and still not notice they're gone. That's the difference, because then you're only at 10% vacant. But this is the difference. This is how you diversify. It's called scale. More units, more numbers. The most important number in most real estate apartment building deals is the number of units. The more units you have, the more diversification you have, the safer you are in that thing. All right, so this is important, because this is when you think about what you're doing. When I'm looking at my world, my life, when I'm looking at real estate, I'm an investor. I'm looking to invest money in a deal. I'm looking to make money on that deal, and I'm looking to succeed. And I want to remove the guesswork. I'm not gambling. Speculation is gambling. Period. No matter how you cut it. Right? So now, I want to share that with you because I think this is important, because if you need passive income to overcome these things, like I said before, if you had a apartment building that was kicking off $10,000 a month, that's passive income to you, right? You're getting that income. It's coming to you passively. That's different That's not speculating. You know this is going to happen. Even if the values went down, you're still not losing the income. The income is sustainable. But if you were like I said, we're using this example, you were in Wall Street back then in 2007 and you were 60, 70 years old, you got wiped out, man. Your stuff went to goose egg. That was the issue back then. And I don't want you to get into that situation right now. So just for this purpose, I love this training because I like talking about this stuff. Investing versus speculating. There's a distinction between the two. You are not gambling. If you're looking at investing your money in something and you're like, man, I have to buy it low because when the value goes up, I make money. That's gambling. That's speculating. You don't know. If you're investing money in something that you know that has a track record. Hey, this thing has always made money. It's always doing what it does. It kicks out money. And at some point, it's always going to do that. It's going to keep on doing that. It's going to always make money someplace, right? That's investing. There's a big difference. And you know that because it's kicking off positive cash flow, passive income and passive investing to you guys. All right. So I hope this thing helps you. Again, be an investor. Don't be a speculator. All you guys out there that are running to Wall Street, that are trying to leave your money, saving doesn't work. I'll do a video on that later. But this matters, guys, because if you're thinking about investing, think about investing money and making a return on your money. Same thing with the houses. Like I said here, buying one house in hopes that they say this was a great investment. That is not a great investment. That's scary. You need to buy something that has multiple units, multiple doors. Turn your digits into doors because now you have scale, you have diversification, you have less. This is an investment. This is not an investment. That's a nightmare. All right. So I hope this helps you guys. Share this video, like this video, comment on this video. If you hate it, don't be a hater and a hider at the same time. Give me a thumbs down, but share with me what it is that you liked on this if you can comment. Oh, like and subscribe. Share my channel. We're trying to grow our viewership. We're trying to grow our subscribers. I want to help more people with this information. I do this for free. The least you can do is subscribe or share it with somebody else. I'd really appreciate that. Or leave a good comment. So let us know if you need anything. Oh, by the way, if you're interested in possibly investing with us, go to bell-capital.com. You can either schedule a call with somebody, myself, or somebody on my team, or you can push get started and you can go to our investor portal. You can take a look at what we have available, the opportunity that's there, and we will you can sign up for that. And then we'll give you more information. Like you can jump on a Zoom with us. We're having one later. Whatever that is, I want to help you. I want you to be a part of what we're doing. And I want you to learn this game. I want you to better understand how people are out there building wealth for themselves by investing in multifamily apartments and how you can do that for yourself and your family as well. All right. Have a great day today. I appreciate you guys. Looking forward to talking with you, connecting with you. And like I said, like and subscribe to the channel, share this video, and we'll get with you guys next week with more videos, more trainings like this when we come. All right. Have a great day today. Let's go.